Welcome back to Higher Exchanges, the #1 independent cannabis investing show, where we break down complex cannabis markets into clear insights you can actually use. Here are your hosts, Jesse Redmond and Morgan Paxhia.
Welcome back indeed. I am Jesse Redmond, Chief Strategy and Investor Relations Officer at Leaf Brands, and I'm back with one of the smartest cannabis investors I know. He's the grizzled veteran. He's Morgan Paxhia. Morgan, how are you?
Feeling a little grizzly. No, doing great. It's good to be back. I feel like it's been a couple weeks. I know we're trying to be like a twice a month cadence, but this break felt like a little longer than we've been doing, so it's good to be back. I'm looking forward to talking to Steve too.
Did we go 3 weeks this time? I feel like we might have gone 3 weeks this time.
Yeah, I think so too.
Yeah, so we'll still hit 2 a month, but sometimes we do back to back. Sometimes we space about over 3 weeks. But yeah, it does feel good to be back. Plenty to talk about. And we're joined by one of our favorite guys in the space and a long overdue guest for Higher Exchanges. We should have had you on sooner, but we're excited to have you today. Please welcome Steven Ernest, Head of Originations at Chicago Atlantic. Steve, what's going on, man?
Thank you both so much for having me. Excited to be here and chop it up with some of the most experienced financial minds in the space.
Yeah, we're excited to talk. Some people, Steve, I talk to more on Higher Exchanges than I do in real life, and you're the opposite. I think last time I saw you, we were at the Benzinga conference, and I believe we ate pizza or something, or ate lunch at a Red Robin together, which was completely random.
We did. That was in Anaheim. California, coincidentally. Yeah, I've got a lot of friends I see like all over the road in different cities, and I love that.
And we had lunch with Chris Ball that day from Ball Family Farms, and Chris is an awesome dude, great company, great flower, huge, jacked former football player. Yeah. And Steve, I'm sure, Chris, I'm sure you won't listen to this, but if you do, this is all in jest. He had the funniest lunch order, guys. He ordered a pepperoni pizza, well done, which was not totally weird, but for a huge jacked athlete, struck me as a little strange. And his drink order was a Shirley Temple.
Get it hard, I guess, you know?
I don't know. For some reason, that cracked me up. But yeah, really good to have you here, Steve. Sometimes I'd like to start with a little bit of context, because I think especially for guys like us that have been in the cannabis space a while, it's always cool to hear about what got you into it. Because all of us have had some reason to come here, and I think maybe even it takes a better reason to hang around, Steve. So kind of what's your how you got here, and what's your why in terms of why you're still hanging around the space after this tough run we've had?
Great question. So, I was a banker at JP Morgan, and some of my clients were some of the earliest investors in GTI and Cresco, right? And some of the big names that are still very much around and actually doing pretty well today. And, I was a young guy sitting at my desk at JP Morgan, and, some of the folks around me were 85 years old and have been there for 50 years. And I was like, this is kind of a long, tough road to the top here. And I kind of just thought that there was a big delta between the perceived risk and the actual risk when it came to this plant that I just sort of believed in inherently. And so, the bet was like pretty simple. It was I just had a high conviction that this industry was going to be bigger in 10 years than it was when I entered it, and that in my 30s I would be able to be sort of an expert on the space, right? And somebody who like you couldn't just come in the room and be like, oh, I've been doing this for 30 years. Like, let me tell you how this goes, right? And it's definitely been a windier, tougher road than I think I would have imagined when I got into it. I'm glad future Steve didn't tell me what happened, but it's been an incredible journey. I've learned so much and just built such a strong community. I think my favorite part is just the people in this industry that I think has kind of kept me engaged and in the game. I mean, some of my closest, lifelong friends are folks in the cannabis industry, right? Who we've kind of been at war with, right, for 10 years. And Morgan, one of Morgan's, colleagues and friends, Patrick Ray, one of my oldest friends in the space. He was actually my first investment when I got into cannabis was through his Canopy Boulder structure in 2014. And so, Patrick and I got dinner or whatever last week. And so it's like, those friendships are really what makes it all worthwhile.
Yeah, it feels totally different than if you build relationships during good times. We've all been around the block enough. I think I've been around the block the most times of all of you, being a man, I can't believe I'm 51 years old, but I was there for the tech wreck front and center, Steve. And like those kind of drawdowns, I think are incredible experiences to learn from and form a lot of bonds. I think we've done enough bonding in the space now through these hard times that I'm ready to celebrate some good times with you. I feel like we've been through our adversity together. What keeps you around, Steve? Like why not tap out? You have a very diversified background, come from the traditional finance space. You mentioned JP Morgan. You had a strong career, kind of like Morgan and I, like you started off on a trajectory in finance and took a veer over here to the cannabis side. And even though it's been miserable, man, I won't even go further down that road. Even though it's been super hard, you're still here. So why didn't you tap out 3 years ago?
Honestly, at Chicago Atlantic, I found a group of people that I just felt like I could run with, really fast and build really interesting things. And frankly, for the first 5 years, I figured out, not every way, but many ways not to make money. And then during the last 5 years, I really figured out how the economics of cannabis works. And we've been able to build a pretty impressive track record here at Chicago Atlantic. When I started here, we were a couple $100 million, and now we've deployed over $3 billion into the space. And so, although the last 5 years have certainly been, challenging, I think that we have the team here to go out there and compete and build investor confidence, and investors are continuing to put their dollars with us. So, honestly, if it wasn't for Chicago Atlantic, like, I don't know if I'd still be here, right? But being here has just been an incredible seat. I mean, this office is a half a mile from my home where I live. And again, I can't say enough good things about the team and the people that I get to work with every day here.
Could one of you turn off notifications? There's just
thanks.
Yeah, no worries, Steve. I should have told you backstage.
I should have.
He's a popular guy. He's got a lot of notifications coming in.
Let's see here. Here we go. There we go. That should be good.
Great. And before I throw the keys over to you, Morgan, to talk about an awesome dispensary software company, Steve, can you give us a little overview on Chicago Atlantic? I know we can look up the public vehicles, but what does that broader platform look like these days?
Yeah, so the general thesis, we're not necessarily a cannabis fund. We invest where risk is misappropriately priced, cannabis being the largest bucket in which we do so. Sorry, let me turn off these notifications. I don't know whether they're still going on. I got a new speaker system yesterday, which I realize is poor timing for this.
You're good.
But it's a 80% plus of the investments that we've made are in the U.S. cannabis industry. So it's like, that I think it's like, I don't know, 3.5 or something like that, but over 3 billion now deployed into cannabis. And we've been growing sort of outside. Our one of the founding partners, Tony Capel, whose office is right next to me here, brilliant credit investor. And I think that's sort of the backbone in which we've found success in this space, because, we didn't just come in like thinking about cannabis values and cannabis businesses. We came in thinking about sustainability of cash flows and actual liquidation collateral and operators and entrepreneurs. And so we've taken that focus and that skill set, and we have spread that across to other industries as well. And so, we're that kind of a alternative investment platform, right? We invest really, it's like where banks won't go, right? I joke we go from like vice to virtue is a theme that we look for. So yeah, I mean, we've done everything, from private islands to spaceships to electronic dog collars. I mean, there's a lot of deals on the web that you can look at, but where we can kind of drive those, mid-high teens returns and feel good about the senior security position. That's where we're expanding.
Nice. Well,
yeah.
Morgan, you want to tell us about some great dispensary software?
I didn't know about. Sure. Yeah, I'm excited about this. So FlowHub just launched a Pay by Bank, which is a prepayment option for FlowHub e-commerce. So dispensaries can now accept compliant online payment pickup orders directly at checkout. And the why is increased order commitment. Shoppers are less likely to ban pickup orders when they've already paid, right? Fully compliant, Pay by Bank runs on the same ACH payment rails used for payroll and other direct deposit, giving low-risk way of offering seamless cashless payments. One hub for online and in-store orders. FlowHub POS, online ordering, inventory, deals, and payments all work together in one system. So a couple of key data points around this. Cash's share of gross receipts dropped from 65% to 59% in a single year. Cash customers are limited by the physical bills in their pockets, contributing to a 7% decline in AOV. Integrated digital payments, ACH and apps represent the highest value tier, nearly double cash at $93.50 average order value. So request a demo today at flowhub.com.
Yeah, I remember on 420, I went over to our friend Glasshouse's store, the pharmacy in town, to grab a couple of things. And the first thing I did, Morgan, was reach in my pocket and say, oh, shoot, I don't have cash. The next thing I did was pay a very high fee for using a debit card.
Yep. And I'm like a order ahead kind of guy. So being able to pay and then just go grab it is that's a huge benefit for me. I think that's just makes it that much easier for folks that know what they want. Which is just great for the stores too, because then the people that don't know what they want, it frees up more bud tender time to help them out. So I think it's great. It's just the more normalization of cannabis, which is also a great thing. So go FlowHub. Sorry, a little bit congested. All right, so let's dive in on some more Chicago Atlantic. This year has been an interesting year, just kind of going to a macro level. A lot of discussion around private credit. With plenty of things going on in the news around Blue Owl and these other things. And Chicago Atlantic seems to just keep humming along and getting things done. And so kudos to you guys. But, and obviously, or not obviously, but for us finance junkies, longtime follower of Jeff Gunlack, and he's been, kind of out there making a lot of noise around this private credit things. But I don't know if Steve, if you heard this, what Jeff's been talking about, but I was just curious if you have, what do you think those comments say about the broader private credit market today? And, what's kind of driving this? Is this a valuation issue, a liquidity issue, credit quality? Like what's kind of going on in private credit?
So, private credit, went from like the darling child to a dirty word in like 6 months, it seemed like, but, I don't know. I guess we don't really necessarily think of ourselves as a private credit manager as much as an alternative financing provider. And one of the interesting things about the Chicago Atlantic platform is that we have been kind of heavily focused in on the cannabis industry, right? And we're kind of the biggest investor in this niche. And part of what we pitch is that we are uncorrelated to other markets, right? And so I think where a lot of these private credit managers, a lot of the news that you hear, I think, software is a big one, right? The groups that came in and said, oh, you're trading at 10 times ARR for your software. I'm going to, put a senior secured credit facility at 5 times ARR. And then AI came around and it was like, oh, the ARR is going down and I wouldn't even pay 2 times ARR for that. And so there was kind of this, perceived overnight markdown of those types of credits. And so I think that a lot of the news is centered around that. And I don't know. I mean, listen, like obviously, like we've got a great underwriting team here, but like there's probably a luck component there as well, right? Like we just we're not in software. That's not like software is not our niche, right? And software kind of covered a lot of different private credit funds. So yeah, I think there was that, and there's just like I feel like there was like the typical amount of like fraud that you hear in the marketplace that just got highlighted in this private credit negative narrative that exists. And, again, like it's just, we've got, we have to navigate the cannabis industry, right? Which comes with its own unique challenges, but they're kind of uncorrelated, I think, to what you're hearing in the broader market and what Jeff is talking about.
Yeah, I think that's fair for sure. We are not correlated. We've been kind of in our own silo.
Yeah, forever. We are.
Markets go up, we go down.
Well, think about it. The last 5 years, Jesse was saying, it's like the last 5 years in the market have been a crazy bull market for everyone. In cannabis, it's been a knife fight in the mud. Right? So, I don't know. The next 5 years could, I think if we got a whatever, a recession of any kind, cannabis, I don't think it would be that core. Like if you got, federal, whatever, rescheduling for adult use in the same year you had a 2008 like crash, like cannabis would probably go up and the rest of the markets would probably crash, right? So like there's some correlation obviously with consumer spending, consumer wallet, oil prices going up, average basket size. I'm not saying that we're completely immune to macroeconomic forces, but anyone who follows, certainly cannabis equities, I'm not sure. I mean, it's correlated to the regulatory changes, really, right? It's not, I mean, more so than financial performance, right? I mean, it's ticks up and down a little bit on financial performance, but one tweet from Donald Trump and it goes up 30%. So it's like, so yeah, I just think that we're, kind of uncorrelated to that broader narrative.
Yeah. Yeah, that's fair. I mean, for sure, especially software being a big aspect of that. I've definitely heard about that impact, where AI is re-rating these things a lot lower. Software, obviously, like if you look at the IGV, it's down massively, and people are questioning the future cash flows of these things and their ability to manage. But it's also interesting is that how it doesn't seem like that disruption is really there. So, and you said the word perceived, and I think it's an interesting application here in the talking about private credit, where there's just, so to me that's more of a signal of not credit, but credit quality, that is, but around liquidity. And like you said, there's so much money that was flowing in so aggressively, and they were working so hard, and so any kind of retreat of that probably does cause more of like a flow issue than necessarily, at least in the near term, a credit quality issue.
Yeah, for sure. And like I think we're in this this AI buzzword world, right, where I think everyone is either wildly optimistic or wildly terrified, and like people don't necessarily know where this is going to go. And like I think that the software architects of those companies are going to be able to pivot and find new ways to get out of this. So yeah, I don't know. I think that I think it's an overblown narrative as it sits today, and I think that AI is probably going to take longer than people think to actually get implemented and displace some of these things. So yeah, I think private credit in general is stronger than the market perceives, and I think that cannabis is basically totally uncorrelated to that broader narrative.
So being in our own kind of cycle that we are, where do you see the credit quality environment today versus where it was like a couple of years ago? Do you see improving fundamentals with companies you're looking at? Are they still, how are they managing through, and how does it look from your seat?
Yeah, I would say absolutely we have stronger credit profiles than we had years ago. Something I like to say is the industry will never be this fragmented again, and it's more consolidated than it's ever been, right? Like those two things are very hard to argue with, right? And so the last 4 years, like we had our own boom bust cycle that all three of us very much so lived through in this space, where you had the I call it Canadian funny money came in from whatever, maybe like late 17 to 20 kind of, right, where there was these crazy investments. I mean, big alcohol, big tobacco, which I love when people are like, oh, big tobacco and big alcohol might get in now. I'm like, how soon we forget that these companies already put billions of dollars into this space. We don't have to pretend or like wonder if they're interested. They're interested. They put a bunch of money in and they lost it. And so I think the last 4 or 5 years was sort of suffering for the sins of the past, and investors saying, okay, now prove to me that they're, the return on invested capital is really there. And as someone who's been in this space for over a decade now, I think it's the lowest valuation, strongest asset time that we've had in the history of the cannabis industry to go out there and deploy dollars.
And why do you? I think that's an important statement that you've made, Steve. My counter to that, personally, is I feel a very similar manner, but But if I were to be critical of myself or just honest, I felt that before. I didn't feel it as much recently. Like I felt like after Florida fell through, we're pretty obviously in a tough, in a tough spot after that, waiting for reform. So I feel a little bit with the boy that's cried wolf, and so that's why I've just kind of stopped making predictions. Period, specifically on the political side. But I do agree, Steve. It feels like Morgan and I talk about that behind the scenes. It feels like there's a lot of great stuff going on. It feels like things are improving. Companies like Leaf are doubling their gross profit over the last year, and pretty much no one cares because there aren't real investors out there doing the work right now. So I'm curious from your perspective, Steve, like why do you feel like you're seeing that setup specifically right now?
There's a confluence of so many things. Break it down let's put it into 3 different buckets. The first bucket, which is what is very much within our control, is the fact that you've separated the wheat from the chaff, right, over the last 5 years. If you were just someone who's like, oh, I love to consume cannabis and I'm at the right city council meeting and I want a license and therefore you're going to pay me $10 million for this license, that's all pretty much gone away, right? Like that was very common five years ago. It almost doesn't exist now. And now we have the real operators who are like, I'm a retail operator, right? Or I'm a manufacturer, right? Like a brand, like a Jeter or a Wild, I'm a diversified retailer who runs 100 retail stores across the country, and I'm vertically integrated in a lot of my markets. And so I can go out there and acquire a store for 2 times EBITDA, put my own products on the shelf, and pay less than a 2 times, EBITDA multiple on a go forward basis. So just fundamentally, the operations, the infrastructure, and the operators that I see in this industry are much better and stronger competitors than the average operator that I saw 5 years ago, and including you guys and including us, right? I'm a better investor than I was 5 years ago. I've got 100 reps under my belt that I didn't have, and we've learned a lot, as investors and operators. So that's sort of the first bucket, which is like us evolving as an industry into a stronger industry. The other 2 buckets are on the regulatory side, but this industry, as I mentioned before, trades largely on regulatory reform. If you look at the CSE, where the majority of cannabis companies are traded, and you look at the chart over the last, call it 5 to 10 years, the bumps are on regulatory. They're not on earnings, right? It's on. Oh, we talked about similar. Chuck Schumer tweeted about safe banking, right? It's rescheduling. It's the Georgia Blue Wave, but you guys probably remember in 2021 where we're like, oh, we're gonna have a liberal progressive government here. This is good for cannabis. And so it's largely traded on that. And I would argue that we are having the most robust conversation with the federal government as an industry that we've ever had before. And so I think that is fundamentally positive, regardless of how the June 29th hearing ends up. It seems like we're going to get mildly optimistic to medical cannabis will not be subject to 280E, to the very optimistic of, wow, this is really impractical to split up adult use and medical in these states that have dual licensure all over the country. We're going to remove 280E and set the foundation for things such as payments, as Morgan described. The death by 1,000 cuts that we face in cannabis, uplisting onto the NASDAQ, getting real liquidity, real custody. These are the things that are going to foundationally change, sort of the headwinds that we've been facing into real meaningful tailwinds. And the third bucket, which potentially is to me the strongest thing in the near term, is turning hemp back into rope, and stopping this intellectual dishonesty, right? That the 2018 Farm Bill intended to sell psychoactive cannabinoids at gas stations. And so I think that reversing that trend, I was with an operator in Cincinnati, Ohio last week, and they said 2 hemp stores shut down right around their store, and their sales the next month were up by 70%. Now it was 420, there was April, there was some other things that were moving the needle there, but that's a tangible increase in revenue and more importantly, a tangible increase in profitability, because you don't have to go open a new store to get those sales in, right? You've already paid for all the fixed costs. So that's like real meaningful profitability coming back into cannabis. And an operator was talking to me the other day, and they were like, yeah, it's kind of nice. The hemp industry, they paid for our advertising bills for the last 5 years, and they were taking the sales, but the sales are going to come back into us. And so I was like, yeah, it's an interesting way to look at it. But I think that we've got some real tailwinds in the industry here for the first time. I mean, since 2016, and the 8 states that went legal, and and the proliferation of cannabis across the United States. So I'd say I'm more optimistic than I've ever been in this space.
So two follow-ups on that. One is to your point, like consolidation's happening, which is great. I'm a huge proponent of it. To your point, it'll never be this fragmented ever again, which is good and necessary. But we're still in this cycle, as you're mentioning, of like companies getting taken out at 2 times EBITDA, which is largely liquidation value or worse. So these are like basically there's no return for the shareholders. It's largely equitization of probably their debt. If they're lucky enough or fortunate enough that they didn't have debt, there would be a little bit of recovery, but it's still extremely low exit values in this consolidation cycle. And it's great for those that are doing it. Kudos to Vireo for putting their foot on the gas and doing this and doing so aggressively, while others are still kind of licking their wounds from past challenges in their M&A cycle. But Vireo kind of coming in with fresh energy, getting shit done. Good for them. But I'm kind of curious from your perspective is like, when do you think, and credit tends to lead equities, right? So like, are we seeing a cycle where things are consolidating enough where we could start to lift off of the 2 times floor that we've been in? I think that's great for the whole sector, is if things could normalize a bit. And the second part of that question though is, I'm doing my run through of all the Q1 numbers of the pubcos, the largest pubcos. In aggregate, there's like no growth in these top 10 companies. It's flat outside of Vireo, which is rapidly shooting through the ranks. But otherwise, it's like 1% on average for the top 10 year over year. And their cash flow margins are degrading, continuing to degrade. It's been quarter after quarter after quarter of operating cash flow declines as a percentage. It's something like, I don't have it in front of me, but double-digit declines in operating cash flows. Mm-hmm. So are you seeing better credit on the private side, or how are you, when you're talking about like things improving? I'm not seeing it necessarily on the public side, especially because until we know what happens with UTP, their UTP balances continue to accrue massively. And for those that are uninformed out there, that's the uncertain tax policy where they're just not paying 280E, and it's accruing on their balance sheet as this ballooning obligation.
Yeah, no, it's a fair point. And, I think that the majority of the pubcos who went out there and, acquired assets, they went public on the CSE when was it, 2020-ish, or maybe 2018, 2020, and raised a bunch of money, deployed a bunch of money out there, signed up for a bunch of IIPR leases and signed up for, a bunch of, just whatever, sale leasebacks in general with these escalators at, whatever cannabis pricing at the time, which was, higher than the rest of the market. And they're capped out by their license limits. Now they're trying to go above those, but, largely the growth in these for the top 10 pubcos were new markets coming online. And now we've hit sort of a level of density in the United States of cannabis where there's, again, when I was in California in 2016, there were 8 states that passed, when Trump was first elected, right? The same night Trump was first elected, 8 states, 4 went to medical, 4 went to from nothing to medical, 4 went from medical to adult use. So the growth was obvious, right? But if you're in 15 states and you only have 1 state coming online, the commoditization of those other states is probably eating up the growth that you're experiencing from the, whatever, 1 state or so that's coming online. And so that's why I think you see, groups like Curaleaf starting to invest internationally for that growth. And although I think you have seen those operating cash flows decline, I think you've seen an uptick in gross margin over the last few quarters. And I think that's from the forced efficiencies that we've seen I mean, every earnings call, every CEO for the last 5 years, and Jesse knows this from his time at Leaf here, it's like they're focused on how do we become more efficient, right? And that to my earlier comment is, I think we're the most sustainable that we've ever been, right? You also had groups fall off, right? I mean, look, you've got Forefront, PharmaCann, Cannabis, right? You've had these companies, start to fall off, and so I think that those operators going away is ultimately going to help, because you see this downward spiral of like, oh, I'm going to fire sale my product, or I'm going to try to get shelf space by discounting my product. And like the operators that exist, and have survived through this, they know you can't discount your way to profitability, right? And so, yeah, I think you're seeing stabilization is what I see, more so than like, demonstrable declines in these companies, and any addressing of the uncertain tax position is going to be, a massive credit positive. Now, to your question about public versus private, I mean, yeah, I think in general we do see more opportunity on the private side. I think the private credits are much better than the public credits on the balance, right? They have less access to bank debt, smaller balance sheets. They've got but stronger income statements, stronger profit margin, and they're nimble enough where they can still grow, right? If you're a top 10 MSO, your growth trajectory is just limited by your scale. And we're already starting to see it in Illinois. You're starting to see a lot of the big operators find that second 10 vertical. I don't know if you guys saw in Massachusetts, they just passed the law to go from 3 to 6 stores. And so, for me, I'm looking at groups in Massachusetts. It's like, hey, if you're doing, it's called $30 to $40 million and 20% EBITDA margins in Massachusetts, I think you have an excellent opportunity to go out there right now and acquire 3 more stores. I think there's a great ROI in that type of investment. When I look at groups in like Missouri, right, you got 10 stores, 15 stores, you're going into 15 to 20. We want to go acquire some more retail. There's real growth prospects there. And so, yeah, I think you just have to really understand the economics of cannabis and how money moves in and out of this system.
And just the last one, and I'll pass over, Jesse, was on the exit multiples. Do you think we're kind of in this environment for a while? Do you see that environment maybe as we leading into our next section with rescheduling? Do you think there could be more normalized multiples, or what do you think is a normalized multiple? And I'm sure that's great for you guys too, right? Is better multiples. It's just better for credit as well.
People are definitely more realistic about their valuations than they have been. I mean, part of the almost impossible challenge of investing from 2018 to 2021, 22, when the market started to drop was, I'll never forget, I did a report. I was working with Viridian Capital at the time. It was January of 2019, and the publicly traded Canadian licensed producers were trading at 100 times trailing revenue. And I was just like, I don't know. I was like, I don't know, like how this catches up, right? And obviously, just wearing my traditional JP Morgan financing hat on.
So it was more than what, Air Canada and.
Right, exactly. Yeah, exactly. Like it's just the comparisons were kind of ridiculous. And again, I think that's where we've had success at Chicago Atlantic, because we've always just looked at it as a fundamental cash flow. We never tried to predict what something would be worth. We simply focused on what is the sustainability of your cash flows, and will they be adequate enough to service a debt instrument, right? And so we never got into oh, your license is worth $60 million. Not part of our underwriting, never has been, right? And so yeah, I think that multiples. But lately I've been kind of talking about. I think that this 2x EBITDA multiple, the bargain bin, if you will, in the last 3 years has been overflowing. And so if you're an operator and you're going out there and you say, I'm going to go acquire an asset, and you see, dozens of sellers at 2 times EBITDA, the strong ones aren't even really in the market. They're like, okay, well, I guess I'll just tread water until something changes. But I mean, I don't want to say the bargain bin's been totally picked through, But I think we're on the other end of that curve now, where, again, PharmaCann, Cannabis, MedMen, throwback, whatever, Acreage, even like a Trulieve, divesting from places like Massachusetts and non-core assets, right? Like, we've been going through that exercise, guys, for 3 to 5 years. 2021 was like the first inclination of the stock market dropping and people saying, okay, like what's making money, what's not. And so, I think you acquire as much as you can at these levels, as much as you have the ability to do so, and build the strongest foundational cannabis company that you can. And I think we wake up over the next, I don't know. I mean, it could be 2 months, guys. If rescheduling comes back in June 29th and they say, hey, UTP's gone. We've decided it's all, which again is the most optimistic, I think, possibility of that hearing. But if you come out of that and the NASDAQ says, hey, this ruling is enough for us to go uplist, I think you're on the back upswing to it, right? And what I tell folks is, like, it's a volatile, thinly traded space, guys. Like, just as multiples can trade as low as they are now, let's not forget, we've seen the opposite. We've seen them trade at 100 times trailing revenue. So, like, it could swing up pretty quick too, right? It's not like we're a multi-trillion-dollar S&P industry, right? It doesn't take a lot of volume to change the EBITDA multiples demonstrably. So yeah,
these days.
Well, right, yeah, that's it's so Elon Musk's network. Yeah. Yeah, exactly.
Do you think it's fair to say, Steve, that overall Chicago Atlantic has been a bit more conservative? Whether I was an analyst or working at Leaf now, I've spoken to you and Dino, the whole team. And first of all, you guys are a class organization. Like, you guys do real research. You really go through the process. And so I've always appreciated how thorough. You guys are also straightforward with folks about who you're a fit with and who you're not a fit with. And it's another, a thing I like about the way that you guys do business. But do you feel like, Steve, that Chicago Atlantic has benefited from being more conservative? And do you think, as this optimistic case you've been painting a bit evolves, that it's possible you'll get a little bit more aggressive on the lending side?
I mean, I would argue that our aggression comes more in the form of Vireo, right? Where we're going out there and, like, voting with our dollars that we do think valuations are attractive, and we're happy to roll up at these prices. Now, on the credit side, we're super disciplined, patient capital. So I would actually say no. I mean, to us, Suzanne, it's just there's the math component. Then there's the art component. And the art component is just, having guys like me and the team who have been in hundreds of these facilities and talked to thousands of operators over a decade, and knowing what it takes and what sort of team I'm looking for that will actually be able to sustain their level of profitability, not just like hoping and saying, oh, you got a dispensary on Long Island, you're doing 20 million in EBITDA. I'm going to underwrite this like it's going to exist forever. It's like, no, like I've got enough scars on my back. I've got enough turns through this stuff. I would be very apprehensive to underwrite, a $60 million single door dispensary of any kind. And I would say, okay, if you want a loan on something like that, like, pay me off in a year. I have confidence that this can exist for a very short tenure, but I guess to answer your question, like, the credit is, I don't want to say conservative. It's just, I hate when I get constant pitches of, like, oh, my numbers are conservative. My numbers are conservative. Like, can we just have an intellectually honest conversation? I actually want to know what you think the numbers are going to be. I don't want them to be conservative. I don't want them to be frothy. I just want to know what you think they're going to be. And let's have an intellectually honest conversation about where we think they're going to be. And if they are not there, what we're going to do about it. And so I think that underwriting discipline is what's allowed us to deploy over $3 billion in the space.
And when we look ahead here, we've spent so much time, in our personal lives, business contacts, publicly on this podcast, talking about what changes with Schedule 3. And I think it's such a big discussion. And my overall view, Steve, which is me being a leading question answerer, which is a bad interview technique, is that the rebound won't maybe be as sharp as we expected because of how long it's taken to get here. And I think it benefits the space very differently because of the damage that has continued to go on during this period. Like, we'll see what happens with the UTPs, but just overall accumulating more debt with declining revenues, margins suffering. I think there's more and more uninvestable companies out there. But I think it's also more bifurcated, where it's getting to be a little bit more apparent who some of the long-term winners may or may not be. So I'm curious, like when you look through this with your lens, Steve, if Schedule 3 goes in our favor, and let's just say we end up with medical and adult use by the end of the year, how do you see the cannabis investing landscape evolving?
Yeah, and I kind of love the way that you're framing this. We're all kind of over a decade long into this thing now, and I just don't view like federal legalization or whatever that even means as like a switch that you merely flip and we're like saved, right? I think about uncertain tax position. I think about this June 29th hearing, seeing what they say, having every cannabis entrepreneur and company take the most aggressive tax position they can based on whatever that is, the IRS coming back out and kind of telling them, no, this is okay, you can't do this, which, based on how gutted the US government is these days, like it's just gonna take a ton of time, right? And so like I'm in this for the long haul, right? And so, I've kind of already, for better or worse, dedicated my life to this thing. And I just like, we're not playing for some big win. I'd say outside of like, when cannabis companies can uplist to the NASDAQ, I think will be like the closest you get to like a jump, like, whatever, like some kind of like fast jump in valuations just because of the pool of liquidity. And then once you start to see people actually achieve equity returns and actually have a track record of investing money into cannabis and getting money back out, you'll continue to see money, flow into the space. And so, yeah, I think it's years, guys. Like it's not, it's I think in terms of years, not months or weeks, right? And so I just view rescheduling as a directional headwind transitioning into a directional tailwind. And so I think over a 3 to 5 year period, you'll just see a reversal of the negative trend.
Mm-hmm. What do you? Yeah, sorry, I'm just double clicking on because this is one thing that just like we bang our heads against the table daily about is, and we don't know, but what if the UTP does not get forgiven? Like, what do you, or maybe I should say, like, how does Chicago Atlantic, do you guys treat it as it's going to remain, they're going to have to pay these things down? Or like, how do you guys think about what's really going to happen with UTP? Or
Yeah, we underwrite the uncertain tax position for our non-finance nerds into all of our deals. And so, our sort of the top, and we're looking for the top companies, right? We're looking to invest in like, call it the top 3 to 5 operators per any given state. And for them, their UTP is typically like a turn of EBITDA is what we find. It's like on a steady state. And we make them pay that down and address that, or we add that to the leverage company. And so in general, Chicago Atlantic, we try to stay under a 2 times total debt to sustainable EBITDA is like a general metric we talk about internally at the firm. And that, the thesis was kind of like anyone who has, any kind of scale, right? Yeah. If you're doing 50 grand in EBITDA, like maybe you're probably not worth anything, but like anyone over whatever, 7 figures of EBITDA probably is worth 2 times, right? Even in like a liquidation or fire sale, right? And so that's sort of what we've anchored to. And I want to address the second part of that, which is, in my mind, like, what is the practicality and likelihood, right? And I think, there's some forces working in the favor of the larger operators. And I think that and this is just my thesis, but in the same way that every large financial institution and every billionaire was protected by the pension funds of every blue collar worker in America in 2008, I think you have to throw every social equity applicant feet first into the wood chipper to cause an ounce of pain to a large publicly traded operator. So when I think about the practicality of the IRS coming in and trying to collect and basically say, okay, if you're a small, because if you say that your UTP is 100% owned and I'm 100% going to enforce that, you pretty much put, I would say, every social equity business goes out of business immediately, right?
They face a double whammy because a lot of them are adult use only.
Exactly. So if you want to go letter of the law like that, I think that you've got a pretty large political and social equity shield. And yeah, you could push back and say, oh, well, this administration doesn't give a shit about that either. They don't care about those people. And it's 2026. The federal government moves in like years. If you think that the IRS is going to have the task force and the determination to go execute on, the most unfavorable interpretation of this in the next 24 months, then yeah, probably get out of the space. But I don't think we believe that here.
What is kind of your base case there, Steve, in terms of expectations? You said you don't believe that it'll be worst case, but what's kind of your base case when you look at it?
I think the base case, let me pull out my cannabis crystal ball here, which is notoriously fuzzy. My base case right now is that it stays medical. Anything on adult use is kind of upside to me. And if it does go to medical, most of the companies, certainly in the Big 10, publicly traded companies, and most of the companies in our portfolio have either a presence in a medical state or a bifurcated license in a place like Illinois or Ohio. And I think you point to the medical side and say, okay, I'm a medical cannabis company, right? And so 280 doesn't apply to me. Like, guys, if we can point to the 2018 Farm Bill and say psychoactive cannabinoids can be sold at a gas station, I think it's pretty safe bet to say that cannabis operators are going to point to saying, I have a medical license, I'm a medical cannabis company. Here's how I treat taxes, and then the onus is going to be in the IRS to come out and stop them. And guys, this is going to play out over years, right? Like, this is not the trial itself takes like a month. Like, where the month, there's like 3 months to the trial. The trial takes a month. I will guarantee you lawsuits will happen from that trial. Like, it's the easiest bet you can make is that there will be lawsuits after this trial by Sam, by advocates. And so it's just going to take a long time. And then you're just going to see people take more favorable tax positions in the interim. And then, the bedtime story I tell myself is that the next president will be younger than the last 12 years of presidents. And that cannabis is an age issue, not a party issue. And by that time, which again, 2 years it's just not a long time, guys. In cannabis regulatory land. And so I think in 2 years, you get a more favorable outlook towards all of this. And we just continue to block and tackle and solve problems and build a stronger industry.
Mm-hmm. Yeah, I think one of the challenges, Steve, has been the lack of clarity in the space. Markets hate uncertainty and investors hate uncertainty. And I've told this story a bunch of times in the podcast, but I remember the year of the Florida vote. Was that 24, fall of 24? Does that sound right, guys?
Yeah, it was the election. So,
yeah, fall of 24. There was some serious money looking at the space then because they thought you might get rescheduling, Pennsylvania, Florida, and we could be off to the races on this rebound. And I was talking to a big small cap growth manager, and he said, Jesse, the problem is, how can I play the game if I don't know the rules? And that hit me. It was an obvious statement. I was like, wow, that's a fair question, because a lot of us at that time were speculating about the rules. And if you look back to then, we're talking, almost 2 years later, and none of those things have happened, right? No Florida, no PA, still no Virginia, and, no clarity on Schedule 3. So it's created this environment where we don't know how it's going to work out. So it's been harder to bring big capital, serious investors along the way, unless they want to speculate on that outcome, unless they're really into cannabis and they have a view of how that's going to turn out. So, Steve, as we get a little bit of clarity here, and I like how you're framing this, because we've got some clarity on medical, we're going to get some more clarity on adult use, then we need to address these UTPs. So it's kind of going to come out in phases. And even on the UTP side, I thought that was smart stuff you were saying about it, that in of itself may take some time to play out. A number more years. So when you look at bringing the new investor in, Steve, because I view the big challenge here that we have the beat up retail group, which we love you guys, but most of us have doubled down 19 times and are pretty much out of money. Some have some fresh capital going into the space. Then the new investors haven't come over the wall yet because a lot of them are looking for improved fundamentals, which you talked about earlier, but also some clarity on these regulations. So as we check some of these boxes, hopefully over the next 6 months or so, Steve, how do you see interest picking up and some of that fresh capital getting into the space?
Yeah, it's a good question. As an asset manager, my product is my track record, right? I mean, that's ultimately what I'm selling, right? I'm like, hey, here's what I've done before, and with your money, I could do more of this, right? There really isn't an equity track record in the space that anyone can speak to that said, hey, I've invested $30 million a year in the last 10 years in cannabis, and my returns have been positive or consistent really in any way. And so, what you're describing, frankly, Jesse, is a great environment for entrepreneurs, right? It's folks who are comfortable and frankly happy to navigate risk and ambiguity, right? And so I think that the entrepreneurs that can continue to build in this ambiguous time are going to be rewarded by the investors who start to trickle in. And Morgan's earlier point, we're voting with our feet here with the Vireo platform, right? Like, we are the platform who is, I think, starting. We're trying to at least start the fire a little bit, right? And if valuations go from what are publicly traded companies trading at an aggregate 6 times, Morgan? I don't know what it's at. If you look at top 5, top 10, if we go from 6 to 8 times to 10 times, okay, like the stuff that we're doing starts to look pretty good. The people who have put money into the public markets start to look pretty good on the equity side. If you get some regulatory certainty on the UTP and how we're going to regulate this on the federal level, if you get exports over to Europe because we're medically legal now, you start to build that case, right? And I think you start to see the capital trickle in, and when you start to see returns, more money will follow. So again, I don't think there's like a silver bullet, right? Where it's like, oh, what's the lever? What's the one thing I have to watch for in order to make this successful? I think it's just ground and pound, blocking and tackling, hard work, going out as an entrepreneur and building a platform that has the ability to sustainably produce profitability. And if you're focused on that, the money will come.
Mm-hmm. Mm-hmm. Yeah, I think that's well said. Last one, Morgan, then I'll throw it over to you because I know we're running a little bit late, as we always do in higher exchanges.
Fast, yeah.
Time flies when you're having fun.
Yeah.
Is rescheduling, do you think, categorically bullish for you at Chicago Atlantic, Steve? Or do you see any risk on the business side that this brings in more capital, which leads to more competition? Because one of the advantages you can have on cannabis at points in the cycle is you've got money, right? Like if you're coming in fresh to this environment today, knock on wood, that could be a great time to be deploying capital because there isn't much capital around, which could be advantageous. So how do you feel and how do you see competition changing the landscape?
Yeah, good question. So let's say that the industry gets much stronger and some of the levers we talked about come to fruition. Let's say that the uncertain tax position, let's say that does go away. And let's say that banks start to come in, in more force than they have historically. That will probably just push us into more like first out, last out structures. And frankly, we've raised several $100 million of bank debt. And so when a bank comes in and looks at this industry, I mean, I would argue from a credit perspective, a multi-billion-dollar publicly traded NASDAQ platform that's well diversified across the space is one of the best credits that you could have versus certainly like a single state operator. And as a bank, you should be looking for the most conservative way to deploy your capital into any given space first. And so I think that that capital is likely to move into us to be deployed into the industry. I think that if you remove the uncertain tax position, we can go from 2 times total leverage to EBITDA to 3 times total leverage to EBITDA. And if 1 turn of that leverage goes from a uncertain tax position into a 1 turn of bank debt, that's okay. We can kind of maintain our position in our general risk profile because frankly we consider as we underwrite today as the federal government priming us with that UTP. So I would much rather have a bank, priming me in a healthier industry. And so, yeah, I don't think we sit around being like, oh my God, it's going to significantly erode our position. I think the question for us is more, how much can we grow? What's the total addressable market in cannabis for us as an asset manager? And, that's frankly why we've, been growing outside of the space, right? Because we think we're going to maintain, our dominant position as the largest lender in the space. And regardless of the, ambiguity and changes of the future, I don't really see a future where there's no private credit that fills a pretty big gap for a nascent vice industry like the cannabis industry.
It's interesting about the talking about vice and putting cannabis in the vice bucket it kind of, I feel like that gives mixed emotions from people when people talk about it as a vice, obviously, because vice connotates addiction issues and it connotates people overdosing and deaths and things like that, where true vices, have those implications. But we nonetheless seem to be kind of putting into that bucket. But when you kind of think longer term about cannabis, we've lived in our own bucket. It does feel like there's a bit of kind of bleeding into, so we're not, separate concentric circles, but things are starting to potentially overlap with other areas. But how do you think about cannabis longer term? Like, from your point of view, does it kind of stay siloed, or does it really kind of start to blend in with other alternative areas, vice? I don't really know what the right word is, because I don't really like calling cannabis a vice sector, but I just know that's kind of like a nomenclature that's being pushed upon us. But
Sure.
Yeah, I always love to think it's going to end up in wellness. Like, that's the word that I love, but yeah, it's not totally clear.
I when I first got in this industry, I used to write what I called green papers at the time. And one of my earliest green papers was titled From Vice to Virtue. And I do think that cannabis has been in that transition from vice to virtue, right? And when I think about vice, I think about, when I put my credit hat on, I think of it as a positive, because the broader public thinking this is a vice was the opportunity set for me, right? And that was the delta I talked about in the beginning of the perceived risk versus the actual risk. And so from a private credit manager perspective, I'm okay with banks thinking that this is a vice, right? It's sort of what gives me my window to go invest. Now, as a consumer and an advocate, no, I don't consider it a vice at all. I think that there's obvious medicinal benefits to patients, and I just think it's impossible to talk about liquor or tobacco or sugar or you name it, right? And be like, oh, we're going to tell people what they can and can't do with their bodies. It's like a cognitive liberty issue. And so, I don't mean it certainly as like a derogatory term, right? I actually, when I say it, I think about the opportunity set that it's allowed for all the entrepreneurs that work in cannabis, to come into this industry and build where other people can sit on the sidelines and, frankly, I think be wrong.
Yeah. And we talk about this with like portfolio companies that are, as similarly are starting to reach out, and what they're exploring is other highly regulated industries. So not whether it doesn't matter if it's vice or not, it's just highly regulated, and by nature has more fragmentation and weird nuances and things like that, where we can we're very comfortable doing that, right? We're very comfortable living in this weird space, and we're not the only ones that have these kind of characteristics. And so highly regulated, that was the word I was trying to, or the phrase I was trying to.
No, I like that. But guys, that's the opportunity set that we have here, right? When we do, remember in 2020, things were trading so frothy, there wasn't an opportunity. I would argue right now is I think when you look back in hindsight at the rearview mirror, you're really looking at 2026 thinking that would have been a great time to to start to make some bets in the cannabis industry.
Yeah, and I agree with that. I mean, it's the classic investor behavior. It's money comes in at the top and money's scarce at the bottom. I mean, I'd say you guys are probably an outlier in that, and kudos to you for the platform you guys have built. It's truly been incredible to see it come, from the very beginning, basically, and now it's substantial. And there are groups that are raising capital. Kudos to Leaf and Jesse. They just raised an oversubscribed equity round, which is fantastic. So there are pockets where money is working and moving, starting to move more. But to your point, it's like for those that can act, they are just having a field day, versus the others that are just still sitting on the sidelines. And by the time they come in, it's going to we'll be into that 8 to 10 times EBITDA. The 2 to 3 times are gone, and they've missed it. And that's a huge amount of return that is being left for the few that will do it. So it's not really a question. They're more of just a statement.
It's like the blood in the streets analogy. I mean, we're all capital markets guys here, right? But it's like, when you buy is like one of the most important things in any investment in any asset class, right? And so I think if you're in any industry and you see your ability to buy assets and you can buy sustainable EBITDA for 2 times, I mean, outside of the industry going extinct, in which case, like, you shouldn't be here in the first place, right? Like you said, who was I talking to? It's it doesn't hurt so bad to fall out of the basement, right? Right? Like, how much lower could you even go, right? It's like after 2 times, and it's like the assumption is your business is extinct. And I don't think there's many folks who believe that the cannabis industry has lost ground in the last 10 years.
Yeah. Well, Jesse, I'll pass it back to you. Just keep an eye on the time here. So.
Okay. No, I think everything you're saying is really great, Steve. I think things might be starting to improve. I think, Morgan, I liked your counterpoint. They were not seeing that in the data of the larger operators yet, but I liked the way you framed things initially, Steve, when I gave you the round of applause in terms of a bit of the bifurcation, the improvements in some of the fundamentals that we're seeing, the cost discipline, like it's year of the core for the 4th year in the row or something like that. And I say that somewhat sarcastically because Cresco talked about year of the core, and I think it was 23 or 4.
Yeah.
But they were right, man, right? And everyone followed them, and everyone's got leaner and meaner. We even dropped our operating expenses 16%, 16%, not 60 year over year, while doubling our gross profit. And those are the sort of things that are happening that people just aren't paying attention to. And it's not just about Leaf, but across the industry. Try and, look for some nuances about where you're seeing those types of improvements, and then be mindful of the things that Steve was talking about, like that conversion from hemp. What could Schedule 3 do for us? Could that, lead to, Morgan, I don't have my hand on the screen button, but safer banking? Could there be some momentum there? And it's not clear, guys. Like, I don't think we can categorically, we all have the right to pound the table and say, in my opinion, this is how Steve said his murky crystal ball is playing out. But I think there are cases out there now. There's a case to be more bearish if you don't think things are going to change. If you don't think UTPs and Schedule 3 are ever going to happen, then your views can be very different than someone that's optimistic about Schedule 3 and UTPs. Throw in that hemp conversion, but that's state by state, right, Steve? Like, that's going to help some folks more than others. And I think you need to be able to dig in a little bit to be able to understand, is there exposure to, the hemp conversion for Texas probably doesn't, benefit Pubcos that much, but maybe, Ohio, that's kind of a big deal. So, our friend Scott Grossman always talks about doing the work. And I think this is, a time in the industry where doing that extra work can really be helpful.
Yeah, absolutely. I think this is a great time to be building in this industry. And again, it's at the beginning. The industry will never be this fragmented again. It's the strongest this industry has ever been. It's the weakest this industry will ever be. And so the people who are in here doing the hard work to serve cannabis consumers, I think it's going to be long-term rewarded. I think it's hard to time, right? I'm not a timing guy. I'm an operator and an investor. And so, if you continue to build, eventually the tide's going to come back.
And if people want to keep track of you, Steve, and Chicago Atlantic, what's the best place to give you and the kind of company you follow to keep track of things?
My LinkedIn page, Steven Ernest, and then ChicagoAtlantic.com. We've got a lot of information out there about some deals we've done and how we operate, and happy to chat. So reach out anytime.
Well, great. Well, thank you again to FlowHub for making today's show possible. Read the recent earnings report, guys. Cannabis retail is really hard. You need every edge possible to win. So you better have the best dispensary software, and that's FlowHub, period. If you run a single store, you run a whole chain, go to flowhub.com, schedule a demo, and see what is possible. So thanks to Kyle, FlowHub, and the whole team for helping making higher exchanges possible. And Steve, this was awesome, man. Like I said, it's been too long. Been too long to have you on the show. You didn't disappoint, so I hope you'll come see us again sometime.
Yeah, absolutely. Thanks for having me on.
And Morgan, you know I love you. Listeners, we know we love you guys too. So we'll see you guys back here, same time, same place, in just 14 days. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor recommendation. All investing involves risk, including the loss of principal.